It wasn't a sudden shock. It wasn't a political accident. It wasn't even a failure of complex mathematics. It was the inevitable result of a monetary experiment that has run its course. The pattern is unmistakable. The arithmetic is merciless. We are witnessing the unraveling of decades of easy money. The bill has finally arrived, and history shows us exactly who pays it. To understand where we are going, we must look back. We will examine 3 specific moments in history. 3 empires that believed they could outrun the consequences of debt. And finally, we will map those stages directly onto the world economy today. Consider the Roman Empire, specifically the period from the reign of Nero to the crisis of the 3rd century. The costs of maintaining the legions were crushing. The imperial bureaucracy demanded endless funding. Taxation had reached its political limit, so the state chose the only option left. They debased the currency. The silver denarius was the standard of trade. Under Nero, the silver content was reduced slightly, a seemingly harmless adjustment, but the incentive was addictive. By the time of Emperor Aurelian in the late 3rd century, the coin was barely silver, plated copper. The government paid its debts in this phantom currency. The result was a catastrophic loss of purchasing power. A Roman soldier found that his pay, which once bought a farm, could barely buy bread. The middle class vanished. Wealth fled the cities to fortified villas in the countryside. The state survived for a time, but the citizen paid the price. Just like Rome, the Spanish Empire in the 16th century faced a similar paradox. They had discovered the mines of the New World. Silver flowed into Seville in torrents. It felt like infinite wealth, but it was merely infinite currency. The Habsburg kings waged endless wars on credit, backed by the promise of future treasure fleets. The supply of money exploded, but the production of goods did not. This was the price revolution. Costs soared across Europe. A Castilian peasant found that despite the empire's gold, he could not afford wheat. The cost of living detached completely from wages. The empire defaulted on its debts repeatedly in 1557, 1575, and 1596. The crown protected its interests while the common people saw their savings eroded by the invisible tax of inflation. Just like Spain, the Weimar Republic, in the early 20th century, faced an impossible ledger. Between 1914 and 1923, Germany was crushed by war debt and punitive reparations. The government lacked the political will to tax and the gold to pay. So they chose the printing press. It was the path of least resistance. Initially, it created a confusing boom. Stocks rose, factories hummed. But reality followed with a vengeance. By late 1923, the currency had lost all meaning. A university professor found his life savings wouldn't buy a cup of coffee. The middle class was liquidated not by war, but by the central bank. The speculators and those with hard assets survived. Everyone holding paper was wiped out. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money and fiscal discipline, where growth is driven by production and savings. Stage 2 sees the expansion of the state, where ambitious projects and wars require funding beyond tax revenue. Stage 3 is the turning point, where the government begins to manipulate the currency or expand credit to cover deficits. Stage 4 brings the illusion of prosperity, where asset prices rise and debt feels costless. Stage 5 is the awakening, where inflation begins to bite and the cost of living outpaces wages, forcing the population to borrow to maintain their standard. Stage 6 is the crisis of confidence, where the public realizes the currency is losing value, triggering a flight into hard assets like land and gold. Stage 7 is the inevitable reset, where the currency is either revalued, replaced, or collapses entirely, wiping out the debt along with the savings of the middle class. Just like Weimar, current data suggest the global economy has entered the late phases of this cycle. We see the classic signs of stage 5 and 6. Sovereign debt levels across the developed world have reached historical extremes relative to GDP. Central banks have expanded their balance sheets to absorb this debt, a modern form of debasement. The result is visible in the housing market, where prices have detached from local incomes, pricing out a generation of workers. It is visible in the grocery store, where the purchasing power of the currency buys less each year. The incentive for governments is to keep interest rates below the rate of inflation, a process known as financial repression. This slowly transfers wealth from savers to debtors, effectively taxing the holders of currency to pay down the state's liabilities. Some economic historians argue that modern central banks have tools that ancient Rome or Weimar Germany lacked, allowing them to manage this deleveraging without a crisis. They point to the ability to digitally manage yields and control capital flows. However, the counterargument is rooted in simple arithmetic. When debt service costs exceed the economy's growth rate, the only way to bridge the gap is through currency issuance. The tools may be digital, but the mechanic is identical to clipping coins or printing marks. Under these constraints, the rational move for the state is to inflate away the real value of the debt, regardless of the social cost. The endgame historically arrives in one of three forms. The first is controlled decline. This was the path of the British Empire after 1945. Through strict capital controls, high inflation, and financial repression, the UK liquidated its massive war debt over 30 years. The bondholders lost value in real terms, and the standard of living stagnated, but the system survived. The second form is chaotic collapse. This occurred in the Soviet Union in the 1990s or France in the 1790s. The currency fails completely, supply chains break, and the economy reverts to barter until a new order is established. The third form is a reset and restructure. This happened in Germany in 1948 with the introduction of the Duchy mark. Old accounts were converted at a fraction of their value, wiping out savings to stabilize the system for the future. The only variable is timing and pain. Subscribe to the channel to follow this analysis. Focus on education, build resilience in your personal economy, and pay close attention to the data, not the headlines.